Hello and welcome to MarketSquare, your go-to show for deep insights into business and economic trends. I'm Olaiton Adebayo, and today we're diving into key developments across Nigeria. Stay with us as we break it all down. Welcome back to MarketSquare. For the first time in 5 years, the Central Bank of Nigeria reduced the monetary policy rate from 27.5% to 27%. Though marginal, the decision carries symbolic importance. It reflects the bank's growing confidence that rising price pressures are beginning to ease, allowing room for policies that stimulate economic activity. Now, while the half-point cut might look small, the timing is what makes it significant. It comes at a point where inflation is finally slowing down and the naira seems to be finding some stability. Inflation, which peaked above 24% early this year, has been on a steady decline, falling to 18.02% by September. Food prices, which has been the biggest driver of inflation, and easing slightly thanks to improved harvest and better foreign exchange management. Still, the problem is far from solved. Inflation remains driven by cost factors, expensive fuel, high transfer costs, and unstable exchange rates, rather than consumer demand. While this inflation trend is encouraging, it is still fragile and could easily be reversed if reforms lose momentum or global shocks resurface. Another key policy shift shaping Nigeria's current outlook is the unification of exchange rates. By closing the multiple windows that once distorted the market, the Central Bank of Nigeria is taking steps towards restoring investor confidence and improving transparency. The unified rates now act as a more effective buffer against external shocks. However, for this reform to deliver its full benefits, Nigeria must maintain disciplined fiscal management and credible coordination between monetary and fiscal authorities. A stable exchange rate, more than anything, is built on consistent policy signals. While latest policy easing is seen as a welcome development, the private sector remains cautious. Many firms continue to face lending rates above 30%, leaving real investment growth constrained. For manufacturers and small businesses, the half-point reduction in the benchmark rate is more symbolic than practical. Businesses argue that unless credit becomes affordable, the impact of monetary easing will remain limited. The real test lies in whether the Central Bank of Nigeria follows this symbolic cut with sustained measures that reduce the cost of funds and encourage production. Nigeria's challenge is not only about the level of interest rates, but the consistency of policies. Without predictable regulation, fiscal alignment, and structural reforms in the agriculture, energy, and infrastructure, small adjustments in MPR would do little to change the country's growth path. What investors and businesses want to see is coordination, where monetary and fiscal authorities work in sync to balance price stability with growth objectives. This includes credible efforts to strengthen local production, stabilize power supply, and reduce dependence on imports. But beyond rate adjustments, efforts are already underway to strengthen the financial system. The planned recapitalization of banks aims to ensure that lenders remain strong enough to support large-scale investment in a projected $1 trillion economy. Structural reforms, coupled with a return to orthodox monetary management, could restore confidence in the financial sector, provided transparency and accountability are maintained. But despite symbolic nature of latest policy moves, Nigeria's economy has shown resilience. Growth picked up to 4.23% in the second quarter of 2025, supported by strong performance in both oil and non-oil sectors. The non-oil economy, led by agriculture, industry, and services, continues to contribute more than 90% of total output. Improved security in oil-producing areas and increased production have also helped, but real stability will depend on how well the government sustains non-oil growth. Productivity in agriculture and manufacturing, supported by better infrastructure and access to finance, remains essential for reducing inflation and creating jobs. So while the numbers are showing a bit of optimism, there is still a lot to unpack about what is really driving inflation and how this policy translates into everyday realities for Nigerians. To help us make sense of all of this, I sat down with investor, banker, and economic analyst Mukhtar Mohammed. Inflation continues to dominate national conversations as prices of goods and services remains high across Nigeria. Today, we take a closer look at what is driving inflation, the policies that can bring relief, and the sector that could make a real difference if properly supported. Joining me on the show is Mukhtar Mohammed. Welcome to the show, Mohammed. So firstly, what exactly is fueling inflation in Nigeria and how does it affect the broader economy?
The primary driver of inflation in Nigeria is FX. I keep saying it and I won't stop saying it. Exchange rate is a key driver of inflation in Nigeria because most of what we consume, we import, and even when we don't import it, if, to make it into finished products, we also have to import the machineries. So yes, um, exchange rate is key. So presently, what I tell people, what we are seeing here now, what we are seeing presently now, the downward trend, the inflationary pressure we're seeing in Nigeria is largely driven by the stability we are enjoying in the exchanges, especially the fact that the naira is gaining against the dollar. Yes, people will talk, well, what about supply chain? I don't think that's a problem. Majorly, the problem has to do with exchange.
So what you're saying is that inflation in Nigeria is being driven largely by exchange rate instability. But earlier you mentioned that FX is a major driver. Can you explain how exchange rate fluctuations actually feed into Nigerians' economic inflation dynamics?
Yeah, you talk about exchange rate fluctuation in Nigerian inflation and dynamics. Like I said, exchange rate is the key driver of Nigerian inflation because virtually what we consume, we import, and if we are not importing the consumable, we are importing machineries that make them into finished products. So definitely, exchange rate is a key driver of Nigerian inflation, especially recently. What you've seen in the recent hike in inflationary pressure was as a result of the exchange rate, and you now see the recent in inflation is also driven by exchange rate coming down. So exchange rate play a key role in Nigerian inflation.
So in essence, when the naira weakens, the cost of imports goes up and that spreads down into the higher prices for goods and services. And because our economy depends heavily on imported raw materials, it makes everything more expensive. But now that we understand what is driving inflation, let's talk about what can actually be done to reduce its impact on Nigerians. Mukta, what policy measures can the government take to mitigate the effect of inflation on citizens?
First of all, we have to look at key fiscal policies. One of those policies that if you want to, government want to mitigate the effect of inflation on citizens. I talked about inflation largely driven by FX. Number one, government must make sure FX is stable. Secondly, in the play whereby we have challenge in making FX stable, then government need to take a bite of their revenue. So I mean, the major household item or food item, government should begin to think how they will come into the country duty free, and that without any rate on them. I think that for me will be the key driver if their government is going to be able to take a bite of their revenue, especially for household item, agricultural item, machineries that make them into finished product. This will bring down the cost of those products, and that in fact will bring down inflation.
Actually, that's an important point. So basically, you're saying the government needs to make sure the intervention reach the informal and rural sectors where inflation bites the hardest. But expanding productivity rather than just price control is a solid angle. And that brings us to one key question. Which sector should really be prioritized if we want these policies to work? Are there any specific sectors that require targeted interventions to alleviate rising pricing pressures?
One sector that these are specific sector that require targeted intervention to alleviate inflationary pressure. I think is the agricultural sector, and that sector is very important to the Nigerian economy. So for me, that sector needs intervention because again, in that sector, you are going to be addressing two key fundamental ones that bring down inflation. The other one, job creation, and then food security. When you look at that that sector, you look at if government policy targeted agricultural sector, that will increase productivity, that will bring down the cost of goods and services. That is one in that sector, and that will also bring down inflation. Also, if government policies are targeted on that on agriculture, so we create more employment for the weak, especially those in the especially those in the rural area, and so that also will create employment for them. And then in the urban area, that will also increase food security, low food price, and that will also increase consumption, that will also increase the bottom line, especially of the informal sector.
Yeah, I would totally agree with you on this because agriculture really stands out. So if we want to fix the major problem, access to credit, insecurity on farmlands, poor infrastructure, food production will rise, and that naturally helps us to bring down prices. Plus, it will create more jobs across rural areas, which also strengthens the economy. Now, looking ahead, the big question is, where are we headed? What is the outlook for inflation in the coming months? What are your projections for Nigeria's inflation rate in the short to medium term?
Yeah, my projection on Nigerian inflation rate in the short to medium term is basically going to come down as long as we are able to maintain this current what we are enjoying now, especially the exchange rate. I think if we continue to enjoy that, we'll see inflation come down. Like I said in my opening remark, the key driver of inflation in Nigeria is the exchange rate. So once we are able to continue to see the exchange rate especially between the naira and the dollar, continuously go down, then we will begin to see inflation will also continuously go down both in the short and medium term. And then also we could add to that food security. We'll be able to create more security for farmers to go to farm. That means cost of goods will come down, and that means consumption will come up, and also more companies will employ more, and that also may mean that a lot of Nigerians will have money to spend. And once they have money to spend, especially in the informal sector, which is the key driver of the Nigerian economy, then you're going to experience a lot of effect on the economy. So for me, that is what the government should do.
So what you mean is that inflation might remain stubborn in the short term because of FX volatility and global price shocks. But if the ongoing reform, especially in energy and agriculture, are sustained, we could start seeing gradual relief down the line, and that is very encouraging. But beyond projections, policy also plays a very big role. Now let's talk about what fiscal policy can do to bring some relief. What role can fiscal policy play in reducing rising price pressures, Mukhtar?
The main role that the physical side should play in terms of reducing inflation pressure is to intervene in the key sector of Nigerian economy, and that key sector is the informal sector. Make sure that businesses thrive, and make sure also you improve the income of the average Nigeria by ruling out policy that have effect, that will bring people to have money to consume. And once people can consume, then they are automatically creating income for over 70% of Nigeria. And once the demand is that, once there is availability of those products and the people are demanding for it, then the price will come down, then you bring down inflation. So for me, it has to be government intervening to improve the disposable income of Nigeria, and also help businesses, especially the informal sector, making sure that there are infrastructure that will reduce cost of production, making sure that they are able to bring in the CMG buses so that cost of transportation will come down. That will also drive down costs. They'll also begin to look at specialized intervention in the value chain of agriculture. That also will help.
From what you just said now, fiscal policy should focus on impact-driven spending and not just figures on paper. So more investment in rural electrification, small businesses, and job creation in the informal sector. When people can produce, more prices naturally stabilize, and that makes a lot of sense. And now, while domestic policy is one thing, global trends also shape our inflation path. Let's look at how external forces comes into play. How might global economic trends like changes in oil prices or supply chain disruptions impact Nigerians' inflation rate?
I think for the first time we are not seeing that happening, because if you look at our oil benchmark projection is $70 per barrel. Presently, oil is not up to $65 per barrel, hovering between $65 to $66 per barrel. So ordinarily, by now, would have seen that trend affecting our economy, then affecting our foreign reserve. But you are seeing our foreign reserves is growing. Now, two things are responsible. One, the dollar itself is becoming a weak global currency because of the policy that is by the current American president, which is American first. So America is becoming a local player rather than a global player. That is one. Secondly, the naira to dollar swap deal between Dangote refinery and the government, whereby Dangote is able to buy crude oil from the government using naira to pay instead of dollar. I think those are the two major decision policy by government that has not made us seeing the effect in terms of change in oil price or global supply chain structure. So that's why we have not seen that. If we don't have these two policies, I don't think the naira will be where it is today, because that means the demand for FX will be high in terms of bringing in petroleum products. Then if Dangote was paying in dollars, that means the marketers will also be buying in dollars. So the demand for FX will be high and the supply will be low. Definitely the exchange rate would have gone up. Supply distortion in terms of will be there, because again that means a lot of goods will not be able to be imported into this country because of shortage of FX. So I think we've been able to go through that now, and also our improvement in revenue from the non-oil sectors are also helped us. And so what would have been a shock because oil price is going down, we are seeing that being absorbed in terms of improvement in the non-oil sector.
Okay, so as you said, we also need to strengthen non-oil exports so that we are not always at the mercy of global shocks. But finally, let's talk about solutions now. What step can the government take to ensure stability in the foreign exchange market and reduce high price growth?
I think one of the ways to attract more foreign investors into the Nigeria equity space, especially equity market, the fixed income market, and then also that will depend on government policies. So if those policies come in, they'll be able to attract more FX into the economy, because liquidity is key to maintaining stability in the FX market. So the more the liquidity we have, the more stability that we have, especially from the retails end. Reduce inflationary pressure. For me, I think inflationary pressure, like I said before, is largely driven by fiscal policy. I think one of those policies is the high cost of production. And some of the reason why we have this high cost of production is because the high cost of energy. And I remember government saying some time ago that the high cost of energy was due because of the high exchange rate. And now we've seen exchange rate come down. Exchange rate has stabilized. I think government should work with the power companies to reduce power costs, and that will drive down cost of liquidity. That will also help bring down inflationary pressure. For me, if government are able to do this, that also bring down inflationary pressure. Remember, I talked about them taking a bite over tariff of agricultural items. That also will help drive down inflation.
So from your point of view, the solution is attracting investor confidence. Really start with getting the basics right, consistent policy and stable regulation and reliable infrastructure. Working closely with power companies to reduce energy costs will also go a long way. If manufacturers can cut down on production expenses, we'll see lower prices, and that helps ease rising price pressures overall. Thank you so much, Mukhtar, for sharing your insight on the show.
Thank you.
And that is all we can take on MarketSquare today. From our discussion, it's clear that while policy easing signals confidence, taming inflation would take more than interest rate cuts. It requires consistency, credible reforms, and a stronger push for production-led growth. This is MarketSquare Adebayo. Thank you for watching and see you on the next one.